Thank you very much, Matt. This webinar today is going to focus on how to build a financially driven business valuation. We're going to go through the terminology. We're going to talk about several different valuation approaches and methods. In the end, we're obviously trying to calculate the fair market value of a business. So Fiscal Advantage provides a process to assess, value, and then even forecast the financial performance of small to medium-sized companies. This seminar explains the methodology used to arrive at the fair market value of the business, which is actually phase 2 of our 3-phase process, but I'll cover more on that at the very, very end of the presentation. My name is Roger Jacoby. I'm the CEO of a company called Fiscal Advantage, and we've created a software product called Fiscal Checkup. Dan O'Connell is the founder of our company, and he is online today to answer questions that you would enter into your questions box over on the GoToWebinar panel on that right-hand side. We will be covering a lot today. I won't have time to cover a lot of questions, so if something I say doesn't make sense to you or you have a question on it, feel free to type that in, and Dan will be online to give you immediate answers to your questions. So let's just talk for a minute about business valuations. Most business owners that we have spoken to would love to know the value of their business on an annual basis. Unfortunately, they're not willing to spend the many thousands of dollars to satisfy their curiosity. So what do? They wait until they're thinking of selling or a buyout of a partner or something like that. So actually, a business valuation, if you think about it, is kind of like the ultimate measurement of the success of a business. And in fact, if you used it as a planning tool and had clear understanding of what impacts the value of the business, we believe foundational piece of information that helps make decisions to improve business performance. So our goal today is to show you a process that we believe is undertaken by almost anybody that goes through evaluation. The primary event that our software is missing in order to be IRS compliant is the on-site visit of a certified valuation professional who would not only validate all of the data, but also would understand if there are other qualitative issues that could impact the value that's being calculated. Everything you're going to see in the next hour can be done by hand. In fact, we know a number of valuation professionals that still do it that way with their Excel spreadsheets. But we're also going to be showing you how software can actually do much of the data collection and, probably more important, the calculations for you. I promise this webinar is going to be educational if you want to understand the process. Yes, I'll apologize in advance that it may come across as slightly promotional, but if you focus on what the software is doing and how we arrive at fair market value and all the calculations that go into it, I think you're going to see the value of what you're here to learn today, and potentially even the value of allowing a software solution to do a lot of the heavy lifting for you. Finally, again, valuation is only one step in the process. We believe the key is actually a full, in-depth analysis of the entire business model in order to identify the areas that can be improved to increase the business value. So let's get started. The agenda for today is we're going to look and define some basic terminology regarding valuations. We're going to talk about what we call the 4 critical valuation components. We're then going to show the traditional adjustments to the financial statements, and then we're going to restate the financial statements. We're going to use all that data then, and we're going to calculate both a discount and a capitalization rate, and then we're going to use the data to estimate the fair market value of the business using 5 different approaches to value. We're then going to blend all of the different methods, and finally we're going to arrive at the fair market value of the business as calculated by the software. So as Matt mentioned, if you miss anything, the webinar is being recorded and the slides are available over in that right-hand pane under handouts. I'll just let you know, if you downloaded the handouts before last Friday, the ending part where I talk more about the company is different, but the meat of the presentation has not changed. And at the end, I will tell you a little bit about our process and our company that if you're interested in knowing how we come alongside both business advisors and companies to help them improve. So our first polling question today has to deal with knowing who is on the line today, whether you be a private business, public accounting, business advisor, etc. And if you'd let us know, and what we do with these, if you're not familiar, is we wait until at least 90% have voted or till a minute goes by, whichever comes first. And we want to keep this moving along, so please vote quickly, and we got a lot to cover in the next hour. And again, as I mentioned, as I dive into this now, if you have questions, please enter them in the questions pane, and Dan will respond quickly and accurately. So we have gone ahead and we've reached our 90%, so I'll give the 5-second countdown of 5, 4, 3, 2, 1. I'll close this window. I will share the results. We've been giving these seminars since earlier in the year, and certainly during tax season we had less than a third that were on the accounting side of the world. We're thrilled to see that 70% of you today are from the accounting, 13% of you from private business. We'll be interested to hear your feedback at the end of this to see what you think about using this tool to value your own business. So let's continue on here. I think it's important for you to understand where it's appropriate to use any financially driven software kind of business valuation and where it's not. By definition, our valuation is financially driven. We're going to spend a lot of time going through the numbers, and if there's unique elements of a company that aren't yet captured on the financial statements, well, then the valuation might not be as accurate. For example, if there's like proprietary processes or trade secrets that haven't been realized yet in the financial statements, well, then it's difficult to capture these in financially driven business valuation. In a case like that, it's likely that any software, including ours, would undervalue the business. Because it is driven by the financial statements, it obviously only works on profitable companies. As I mentioned earlier, no software tool, including ours, meets IRS regulations because we don't have anybody making that site visit to talk to management, verify the data. However, we do ask, it says 19 up here, actually we do ask about a dozen important subjective questions where we do try to shed light on non-financial matters, and I'll cover that later. For companies growing faster than 10% a year, it's likely going to understate the value of the business, but what we've learned is the valuation will provide a really good estimate for the significant majority of businesses, and as a planning tool, it's incredibly valuable, especially if you complete it every year using the same methodology. We've learned, and I'm sure if there's valuation professionals online today, that many people have a too high of a view of what their business is worth. Getting that down to reality and then understanding what goes into it and looking at year-over-year changes of a company can be very, very beneficial for a company that's trying to improve its overall financial performance. So just Wikipedia here, a business valuation is simply a process and a set of procedures that are used to estimate the economic value of an owner's interest in a business. So a company's fair market value is by definition the value that a buyer and a seller would negotiate, where both of them have equal economic incentive to buy or sell, both have complete access to all of the information they need, and most often we want to, and what will this valuation is based on the value of an ongoing business. We're not looking at the asset value in a bankruptcy or a liquidation. So every valuation has to start with a purpose, and the American Society of Appraisers, everybody out there, the National Association of Valuation Analysts, even the AICPA use 3 different approaches to estimate the value. The income approach, which looks at the expected future income stream, the market approach, which reviews the industry selling multiples, and the asset approach, which reviews the market value of the assets. But we're not going to be covering the asset approach today in this webinar since we can't determine the fair market value of any assets in a business in this kind of forum. and looking at the different valuation methods that are used, the discounted cash flow and the capitalization of earnings methods are based on income, and there are 3 different market comparable approaches that use the basis of what similar public companies are valued at today in the stock market. Every valuation needs a purpose for the valuation. The appraised value would likely be different between a liquidation value or an estate planning value or even a strategic sale value, and particularly a bankruptcy. For this presentation, we're going to look and focus on the value of an ongoing business that is being sold or purchased. This is very much a market-driven valuation. So there are 4 processes that we need to go through before we can begin to analyze the data. And once we collect the data and we put it into our kind of funnel here, we can then begin to use that data to calculate the value of a business using different valuation methods. So first, we may need to make adjustments to some of the income statement accounts if the values listed do not reflect the company's accurate earnings power. Second, we may need to make adjustments to the balance sheet if the values on the balance sheet don't reflect their accurate values, whether they're assets or liabilities. Third, we need to calculate the appropriate discount rate so we can use that to determine the present value of any future income streams. And finally, we need to estimate that future income stream. Now, when there's discrepancies in valuations, it usually lies with one of these 4 processes. For example, was the discount rate appropriate, or was the future income stream estimated appropriately? But once we collect these 4 sets of data, we can then apply that data to the different valuation methods. So starting with the income statement, the goal, of course, is to reflect the true earnings capacity of the company. Well, to do that, we might need to make adjustments to cost of goods sold and operating expenses, and if there's any excess owner's compensation. So the earnings reflect the true earnings capacity of the company. Next, we want to make adjustments to the balance sheet to reflect the real values of the assets and liabilities. If the inventory needs to be written down or land is not at its fair market value, these will affect the valuation of a company. There are other kinds of adjustments that quite often are overlooked, partially because they're more difficult to calculate. Well, the first one's called deliverable working capital. Well, based on industry comparables, there's an expected level of working capital that would be left in the business upon the sale or purchase of a business. But if the business has less working capital than their industry peers, then the value of the company would have to be reduced to compensate for this shortage. On the other hand, if there was an excess amount of working capital, then the seller would expect that they could receive this excess cash on top of the value of the business that's being calculated. Very similarly, based on industry comparables, there's an expected level of capital investment. Now, if the company has held back on investments to try to improve their short-term profitability, then the value of the business would be adjusted down as the new buyer has to invest funds in capital expenditures to kind of catch up. But we'll cover this a little bit more later in the presentation. So this is a table, just an easy table to present, but this is from our Fiscal Checkup Valuation Report, where we list out the adjustments that are being made to the income statement and the balance sheet. Now, we've highlighted the line here for cost of goods sold. So cost of goods sold on the income statement for a valuation obviously must represent its real cost or its real value. Now, there might need to be adjustments due to the inventory accounting method used, or maybe the inventory's cost basis, for example. Well, in this example we're going to use today here in 2015, the cost of goods sold on the income statement actually overstated the actual cost of goods sold, which actually should have been $10,000 less in 2015. So this would increase earnings by $10,000. Next, we look for adjustments in what we call excess compensation, and for many privately held businesses, this is probably the largest one. For example, if the company had liberal use of automobiles or expenses for non-employees such as family members are being run through the business, well, we need to add those amounts back to the earnings. Or, if the owner was paid a salary of $250,000 when a qualified replacement for that position could be hired for $150,000, well, we'd want to add back in that $100,000 of excess compensation into the earnings. So in this business here, in this example, in 2015, the business had $175,000 in excess compensation, which by definition would improve earnings if the new buyer didn't have these expenses. So next we do the same for any other expenses where the amount on the income statement was overstated. On the other hand, if it was understated on the income statement, we would enter it as a negative number. There isn't any other expenses that required adjustments, so we've entered a 0. So now we've calculated the total adjustments for the income statement for the past 3 years, which was the top level of our funnel, one of our critical valuation components. So let's move on to the same concept, but on the balance sheet. We continue to treat the balance sheet adjustments the same way. Adjustments for inventory could, again, very similarly to cost of goods sold, they could be due to the inventory method used, or price changes, or obsolescence, or theft, or any number of other reasons. Well, here in this company in 2015, the actual inventory was undervalued by $40,000. Next, we look at other long-term assets. Now, this might deal with overvalued or undervalued. Maybe the appraised value of the land where the plant is $450,000 more than the value that's on the balance sheet. Or the company might have insurance policies, or they may have written down equipment down to 0 with accelerated depreciation, but those big pieces of equipment still have value. Well, any adjustments to the long-term assets are entered and documented here. On the next line, we adjust for liabilities. This is kind of unusual. Most businesses don't have an entry on this line, but this could be an allowance for a pending lawsuit or a significant payment that's being modified, or maybe there's a note to a family member that's not on the books or something. Again, most businesses don't have anything on this line. So in this company's case, the total adjustments to the balance sheet in 2015 was $490,000. This means that the company's book value, or their equity, is $490,000 more than what was on the books. This value will be added to equity. Remember this number, 490. You're going to see it later on. We'll cover that later, but we've got our adjustments now for the income statement and the balance sheet. So here we've got both of those listed there. As I mentioned before, companies require a certain amount of working capital to cover operations, and that amount of working capital varies by industry. If the business is short on cash, the buyer needs to invest, then that's going to reduce the value of the business. Now here on line 10, it shows actually that this particular company has over $1 million in excess working capital compared to their industry. So the seller would expect to retain this excess working capital upon the sale of the business. This would be added to any value we're going to calculate for the value, the fair market value of the company. And if by chance this amount was negative, the buyer then would expect to adjust the purchase price to compensate for the lack of working capital. Here's the income statement with all of the historic values from all of the published financial reports, including the revenues, gross profit, operating income, even the net profit before tax. And after we make those adjustments on the top, we create a line at the bottom of the income statement where we add this back in, here listed as income statement adjustments on line 22, which in this case results of an adjusted EBITDA of about $1 million in 2015. And it is this adjusted EBITDA that's going to be used in the valuation methods later on. The third critical valuation input from our funnel that we need to calculate or build is actually the discount rate, which is the return an investor would expect for a given risk. Now, the capitalization rate is just simply the discount rate less the growth rate of profits. Now, profit growth can greatly impact future cash flow, and so the larger the growth rate, the smaller the capitalization rate, and the higher the value of the business. Now, a traditional calculation of the capitalization rate starts with something which we call a limited risk return, which is usually pegged to a long-term T-bill. In a case like this, we have the current return on a 20-year T-bill, but we've had to normalize that rate in order to compensate for the Federal Reserve's monetary policies of low interest rates. Now, it may sound complicated, but the concept here is to determine some sort of risk-free rate of return, and this is our methodology that we use to accomplish that goal. Next, we got to add to that the appropriate return needed for a small business equity risk. Now, this is normally the excess return from investing in the stock market over a risk-free investment. The good news is this number is actually commercially available from a number of sources. They vary slightly, of course. We use data from a company called Duff & Phelps, and we update this monthly. Next, we need to enter the return an investor would expect to receive because of the specific risk of this company and due to a risk of a non-diversified risk, that they're only investing in this company. It's not a mutual fund, which has a lot of different companies to spread the risk around. So we have a proprietary algorithm that we use, and it's summarized in something we call our V, or our viability rating. We look at the company on the 8 different factors that you see listed in or highlighted in yellow here, and our goal here is try to actually look at the future viability of the company. Now, part of the V rating near the bottom of the list is something called market and company dynamics, which is, in order to score this section, we ask questions about the company. We'll get into a little bit more specifics in a couple of slides, but what we're trying to do is assess the specific company risk. We ask questions like concentrations of customers. We talk about the growth rate of their primary market. We ask about changes in the company's market share. We even ask about the competitiveness of their product or service, even the cyclicality of their industry, and others. And these answers actually are discussed in the narrative part of our report, but most importantly, we use the answers to these kinds of questions to kind of assess a company's specific discount rate. So as we continue to look at the V rating, the software compares the company to their own historic trend over the last 3 years, as well as we compare the company to how their industry is performing. The software then calculates and gives the company a score on a full range of 1 to 100. So realize an average company would receive a satisfactory rating of 50. And we use this assessment to estimate the company's specific viability risk. So time for our next polling question here is, if you look at either your company, if you're a business, or if you're an advisor, the companies you work with, what do you think your company or the majority of the companies you work with would see as a rating? And again, it's a full 1 to 100 scale here. The goal here is to truly assess the future viability of the company being analyzed. All right, we're at 90%, so 5, 4, 3, 2, 1. I will close this and I will share the results. And as you can see here, most people believe that they're dealing with either a good or a satisfactory company, and clearly we see that in most of the analyses performed using our software. But we do have 9% that think they're in the excellent range. Congratulations if that's you. And we hope we can confirm that by looking at our, hide this, confirm this by looking at the results of our survey. So when we add these three different returns together, it becomes the discount rate. Now, this is the rate we're going to use to discount the future cash flows when calculating the value of the business. Now, I need to stop here because there's a wide variety of opinions on the appropriate discount rate to use. Now, there's people that, like Warren Buffett, that use a very low discount rate, and we've talked to many valuation professionals that believe that most of small, medium-sized businesses should be discounted heavily, some more than 25%, because of the risks associated with smaller companies. We try to take a middle-of-the-road position. We recognize the company-specific risk where it exists. I just want you to understand that the opinions on discount rates vary widely. I've explained the way we do it. You're welcome to come up with your own methodology of what is an appropriate discount rate. We've just tried to show you all the different elements that go into calculating a discount rate. So the growth rate of profits, which is what we're going to subtract in a second from the discount rate, is calculated quite simply from the company financials. And what we do in order to, again, be more middle of the road, we cap the growth rate at 5%. We also have a minimum of 1%. And we limit it to 5% because high growth companies need to be reviewed very carefully, because there can be many variables that need to be investigated in order to ensure that the company continue to grow at that growth rate for many years into the future. Actually, from the companies we've analyzed, for most companies, a 5% compounded annual growth rate of pre-tax profits is actually fairly difficult to sustain. Another way to arrive at the 5% cap is if you want to combine the GMP growth rate and the inflation rate. So finally, this particular company hits one of our windows there where we limit it. So the growth rate's deducted from the discount rate at 1%, and we arrive at the capitalization rate. And we're going to use the capitalization rate in a couple of slides to calculate the value of the company using the capitalized earnings method. So the fourth critical valuation input component on the top of our funnel is the income stream. Now, the income stream can be measured in many ways. There's certainly many variations of earnings before tax, with or without depreciation, amortization, or capital expenditures, or even the free cash flow method. Owner's discretionary cash, also called ODC, is a common way to measure future income streams, and it's simply defined as EBITDA less capital expenditures plus any negative working capital changes. So ODC does not include interest paid on capital, and we do that so we can measure all of the companies without considering the financial structure of each comparable company, whether it's debt or capital. We don't include depreciation, so the different depreciation methods that different companies use don't impact the earnings. Capital expenditures are subtracted because we obviously need to make sure, as we're looking into the future, that the capital expenditures are being funded. And finally, working capital changes are, if they're needed, if there's an investment needed to finance the future revenue of the company, they're included. And that could be a positive or a negative number on working capital changes. ODC is also often called free cash flow. We start the process of projecting those earnings by projecting the revenue into the future, and we use an average growth rate of revenues over the last 3 years. We're only showing 3 years here due to space limitations, but as I'll show you in a minute, the software actually does the analysis for a full 5 years out. To calculate EBITDA, we then look at a blended average of the last couple of years, but we put a greater emphasis on last year's percentage. And then we deduct income taxes. As I mentioned, capital expenditures are then deducted from this income stream. And finally, the working capital changes that need to be included because working capital is obviously needed to finance the business. So we total all of these different components, and we arrive at free cash flow, which, as I mentioned, is also called owner's discretionary cash, or ODC, but again, it's only displayed here for the next 3 years into the future. So if we go back to our funnel, we've now calculated the 4 critical valuation components. We looked at the adjustments to the income statement, the adjustments to the balance sheet, we calculated the discount and the capitalization rate, and we've estimated our future income stream. Now that we have this data, we can apply this data to the different valuation methods. So to calculate the net present value based on the discounted cash flow method, we need to have an ending or a terminal year where the business would be either recapitalized or sold, so we can bring forward the net value of that future cash, those proceeds in our cash flow stream. Well, to estimate the value of the business at the end of 5 years, we multiply EBITDA in year 5 by the public selling multiple of EBITDA, and we then discount that figure by 30%. The traditional discount between public and private companies due to the liquidity of the ownership shares and the access to capital markets is generally 30%. So this method estimates the terminal value of the business in year 5 is going to be about $8.7 million, and this is documented in that paragraph on the top of this page. So when we apply the discount rate previously described to the free cash flow and the terminal value, we end up with a value using the discounted cash flow method of $5.9 million. We now calculate the value using the capitalization of earnings method. This method starts with the earnings, not including any interest on the debt. We add back in the net capital expenditures, which is depreciation and amortization, less capital expenditures, to arrive at the earnings on a debt-free basis. We apply the capitalization rate that we previously calculated, and we end up using this method of a value of this company of $3.3 million. Now let's look at the 3 market selling comparables methods. In order to have an accurate estimate of the company value, you obviously have to have accurate multiples. Fiscal Checkup, we've gone ahead and compiled our own list of average public companies in each industry by industry or code to arrive at very specific multiples for EBITDA, book value, and earnings. As part of our business valuation report, we show you how the market comps that we use compare to this market. So this graph shows the multiples of what we have is 3 companies in each industry classification. So we show here the multiples of the 3 companies that we've chosen in this specific NAIC code in green compared to the overall multiples in our composite index in red. Note that these values are updated monthly, and our composite is generally close to the industry average, but we've intentionally chosen multiples from middle-of-the-road companies. We're trying to eliminate the extremes, which sometimes in some situations does result in a more conservative valuation. We also show you how our composite index in red compares to the overall New York Stock Exchange in green. So as we look at the 3 different selling comparables methods using our multiples from our composite index, the first market method is the multiples of EBITDA. Since the multiples are for public companies, as I mentioned before, there's generally about a 30% discount because of the lack of liquidity of the shares of a private company. The $1.1 million in EBITDA listed on line 47 includes those income statement adjustments that we previously entered, and this method results in a value of around $5.6 million. The book value is also taken from public companies in our composite index. Because we're working with asset values, there's no discount for lack of liquidity and there's no tax implications. The $3.6 million on line 47, that includes the $490,000 of balance sheet adjustments that we previously calculated. Applying the market multiple for this method arrives at a $5.3 million valuation. Like the EBITDA calculations, the earnings multiple has a 30% discount for lack of liquidity of the shares in a private company. There's also a 35% tax on earnings, but this is the only market multiple with tax implications. The value listed by Fiscal Checkup on line 47 is net of tax. The value based on this method is $6.7 million. To arrive at a blended market selling comparables value, we average the 3 market multiple valuations, and in this case it comes up to a valuation of just under $5.9 million. We've now calculated the value using 5 different methods, including 3 different market-based methods. Time for our next polling. So which result or which method do you think best results or best estimates the fair market value of a company? And again, I'll remind you, if something I said didn't make sense, feel free to type it into the questions window, and Dan is online ready to answer your questions. All right, we're at 90%, so 5, 4, 3, 2, 1. I will close this. I will share this, and you'll see in a second that we agree with you that the discounted cash flow is probably the most accurate. Multiples of EBITDA second, or actually the multiples, and then capitalization is in that case of those top 3 is the least of the 3. So let me go ahead and hide this. So let's just talk really briefly about which of the methods best reflect value in different circumstances. So if the company has consistent earnings, well, it pretty much works well with all of the first 3 methods. A dependable earnings forecast, well, that also works well with the first 3 methods. So if the earnings are expected to materially change in the future, the discounted method works best if the earnings stream estimates are accurate. If a company has high intangible assets, such as special formulas or processes, the first 3 methods are good, but the value of the intangible assets might need to be added back into the value somehow if their value is not yet reflected in the financial performance of the company. The value of an asset-rich company, like let's say an old convenience store located on a downtown corner of a busy street or busy city, well, it might be better done with an asset-based if it owns the land and the land's not at its market value on the balance sheet. A bankruptcy or liquidation would probably best use the asset-based method, but it would certainly require a specialist to understand the value of the used equipment, etc. Growth companies can use the first 3 methods, but it's probably the discounted cash flow that will generate the highest value as long as the forecast is accurate. A startup with no history is pretty much restricted to the asset-based under most situations. So we calculate the value of a business as a going concern. Therefore, we use the first 3 methods for evaluating a business. Now, a true asset-based valuation would require a specialist, and we've talked about that, and we just can't do that based on the financial statements. So this chart has the values that we previously calculated, and then we weight each value. First, the capitalized earnings method is only valued at about 10%. The discounted cash flow is at 30%, but realize that's going to be the most important because the next one, even though it says 60%, is made up of 3 different methods. So the blended selling market multiples is at 60%. After running hundreds of tests on companies, we've looked and determined that these weights, in our experience, best reflect the value of an ongoing business that would meet our definition of fair market value, where a buyer and a seller agree to the value based on all information. This is often referred to as the enterprise value. Now, included in the report is a graph showing the different values estimated by the different methods, along with the weighted average fair market value. Realize if I was the seller, I would want to choose the multiple of earnings methods for my company. If I was the buyer, I'd want to use the capitalization of earnings method. But most accurate valuations, we believe, will consider a blended approach to value because no one method is always accurate in every circumstance. It's best to look at all the methods and then blend them together so no one method can skew the data in one direction or the other. In a couple of slides, we're going to validate that blended value and by determining the buyer's return on equity in a fictional sale. So to calculate the fair market value of the equity in the business, we have to deduct the debt from the fair market value of the company. Fiscal Checkup understands that different buyers value businesses differently, so we generate a range here that's simply plus or minus 10% off of that fair market value. Next, we're going to validate the valuation range by calculating a buyer's return on equity for a fictional sale. We begin by identifying the fair market value of the business, which we did in the previous step. Next, we assume a buyer coming in is going to invest 30% down and borrow 70%, and we're going to have to make some assumptions. So given today's market, we assume a 5% interest rate, which would have an annual cost of interest on the debt of about $200,000. The 30% invested, that's the capital that the buyer contributed to the transaction, and that'll be the number from which they expect to earn their return. Next, we show the adjusted EBITDA for next year, which is projected to be just over $1 million in the first year after closing. Then we subtract income taxes at 35%, and we also deduct the after-tax cost of the debt, which result in earnings adjusted for the taxes and interest of just over $500,000. We divide the earnings on line 62 by the invested capital on line 58, and this gives us a return of just over 30% on the buyer's equity. The return on the combination of invested debt and equity equals 12.56%, and that's a good use because it's above the weighted average cost of capital, which is 6.6%. This means this investment does provide for a good use of funds. Now, the weighted average cost of capital is the average cost of both the debt and the equity. The buyer's cost of capital is calculated by Fiscal Checkup using the company's debt-to-equity ratio compared to the industry, which is referred to as beta, multiplied by the return expected on a risk-free investment plus the equity return. I know it sounds complicated, but again, clearly we've got a great return for this buyer on their invested equity, and you can do these calculations on your own. We can give you the formulas if you need them. So because a buyer, in our opinion, would expect to earn a return in the 20 to 30% range, and we've calculated the buyer is going to be earning a 30% return, the fair market value of the business has been validated, a little on the high side, but it's been validated. Now, if the buyer's return on equity was higher, let's say it was at 40%, well, then it would suggest that a fair market value closer to the top end of the range would be more appropriate. On the other hand, if the buyer's return was below 20%, it would suggest a fair market value closer to the bottom end of the range listed. So here's the narrative in the Fiscal Checkup report that explains all of this, and it reminds the reader in that last sentence, remember that the company had $1 million of excess working capital, more than is custom in their industry, so that amount needs to be added to the fair market value of the company. Time for our fourth polling question. Looking at the returns out there available as people are buying and selling, what do you think is the average rate of return that most buyers expect to receive when they're purchasing a business in today's market? All right, we're at 90%, so I'll give the countdown of 5, 4, 3, 2, 1. I will close and share the results. So you guys think we're a little generous in our 20 to 30% range, and that's okay. I mean, we calculate what it is, and you can make adjustments as you see fit. Slightly beaten out by the people that think in today's market anything in the 10 to 20% range is appropriate. So I'd like to, now I'm allowed in the last 5 minutes or so to spend a few minutes telling you a little bit more about what we do here at Fiscal Advantage and our Fiscal Checkup software. So if you work with small to medium-sized businesses, have you ever wondered what other services beyond tax compliance and valuations those businesses need from you? It's really interesting that in a recent survey of small and medium-sized businesses, 55% said improving their financial performance was their top priority. Almost half wanted external help to accomplish their goals. 44% said their current firm had low or no impact on their business performance. Kind of surprisingly to me, in the same survey, only 12% said they plan to seek a new accounting firm. Fiscal Checkup is an online software tool, and we developed it to assist companies that want to implement change to improve their financial performance. But we don't do it alone. We empower the business advisor with all of the value information that they need to help them succeed. Fiscal Checkup provides a proven process for companies that want to thrive. So let me just show you at a very high level our three-step process. In the first phase, what we do is we conduct a deep assessment into all of the variables listed here. We identify areas for profit and cash flow improvement, and once specific recommendations have been identified, we also monetize the precise profit, cash flow, and business value that could be generated from implementing improvements. Our analytics assessment that goes in depth with this is actually, we have a webinar on Wednesday through CP Academy that goes through this entire assessment phase. But this is where we look back 3 years. Next, we look at today. In the valuation phase, where we spent all of our time today, you've seen that we use traditional valuation approaches to calculate the fair market value of a business. Now, again, in the scheme of a 6-year window, we've looked 3 years in the past, it's critical that we establish a value today so we can measure future improvements against that value today. And remember that a business valuation is designed primarily to answer the question, what is the business worth today? But if you're not selling the business tomorrow, most businesses really also want an answer to the follow-up question, which is, what do I need to do to improve the value of my business in the future? Well, a complete fiscal checkup process, as we're showing here, is really designed to answer both questions. For those of you that perform valuations for a living, imagine having the fiscal checkup assessment report as supporting data for the valuations you already perform. In the third phase, we actually then look 3 years out into the future, and we forecast the business's financial performance, assuming the current continue. But we also let them modify any of the 7 variables here so the business can clearly see how making minor changes have significant impact on future earnings, cash flow, and even the value of the business. Our 3-phase process empowers the business advisor to help their clients thrive. A complete fiscal checkup consists of 6 different reports. The executive summary contains an overall summary, including the recommendations for improvements, as well as the forecasted 3 years out results. In addition, we have a profit driver report, which looks at the income statement, a cash driver report, which looks at the balance sheet. We've spent today talking about the business valuation. We have a lender's report, which is designed to help the business understand how their lenders views them. And we also have an industry comparables report showing them how they compare to their industry on 54 different financial ratios. So fiscal checkup is affordable. The entire process, including the valuation, it's only $495 per company being analyzed, and we do have discounts and subscription models for advisory firms. So if you want your firm to grow your advisory service revenue and improve your business client retention while even growing the number of business clients, then I think you'd find Fiscal Checkup is a solution made just for you. So you have the opportunity to check out Fiscal Checkup with absolutely no financial investment and a minimal time investment. We actually have 2 free reports for any business or any advisory firm, At no charge, we allow you to create what we call a fiscal report card. It's a one-page report that gives you letter grades. Yeah, we're kind of like back to high school of the business, plus an overall grade. It's really easy. It takes less than 5 minutes. It only requires data from 3 balance sheet accounts and 4 income statement accounts, plus the relevant industry codes. And it really gives you a sampling and a picture of what the full report, if they bought it, would be worth. We also provide, at no cost, you guys can get it if you're looking for industry comparables. Well, we actually have a different approach to industry comparables. We allow businesses to choose up to 5 industry codes along with the percentage of revenue from each code, so we can actually create a custom hybrid industry comparable that matches or mirrors the company being analyzed. So we have 2 more polling questions. Here's the 5th one. After you've seen all of what you, oops, I didn't check which one here. Let's try this again. What would be your takeaways from this webinar today? We do have, as I mentioned, other webinars on analytics on Wednesday, and then on Friday we teach a class on benchmarking. So those of you that want to come alongside businesses and you want a process to be able to implement improvements, you're welcome to attend that one. We'll be on Friday of this week. And as I said, the one that goes into the deep assessment is on Wednesday. I will have one more polling question at the end where if you want to have any further contact from us, you can check that, but there's also a button that if you don't even want to be on the email list, you can actually do that and remove yourself from even our email list if that is your desire. Our desire is not to harass you unless you want to have follow-up from our company. So I'm going to close this one down here in a few seconds. We're at 87, 88%. Come on, folks, we need a few more votes to get this closed. 89. There we go. 5, 4, 3, 2, 1. I will close this. I will share the results. Well, we got a bunch of you that we'll see on Wednesday, I would hope, at our analytics and assessment webinar. A few less on the benchmarking. We do have some free reports, and we'll look at a bunch of you that think performing a fiscal checkup on a client would be a good idea. So let me hide this. I'm just going to show you quickly my email address, and like magic, Matt's going to come back on, and there's my email address if you have any specific questions for me. But while we're waiting for Matt, I will also put up this final one. So those of you that want to be removed from our email list, you have that choice, and those of you that want follow-up from us in one form or another, we have white papers, we can email or send you a printed copy of the report, and we may even have some of you that want a personal demonstration or a discussion, and we'd be happy to accommodate however you want us to interact with you going forward. Thank you for your time. Matt, are you there?
I am, and Roger, let me just say thank you very much. Another fantastic job. As always, we appreciate the presentation, the content here. Fantastic job, and I'm seeing a lot of comments coming in as well. I'm working on getting a link together. I'll put it in the chat bar momentarily for your other upcoming webinars this week, so I certainly encourage everyone to take advantage of those the final 2 times for right now that we have those offered on our schedule. So as that poll is going, we'll leave it open for just a few more moments. Just remind everyone of a few of the administrative pieces so we're all on the same page there. This class obviously did qualify for credit. As long as you got through the polls, we're logged in for 50 minutes. You're all right there. We'll get to work on issuing that once we close down here today. It takes us about 24 hours or less. You'll see an email from us, or you can simply log into your account on cpaacademy.org in order to find that certificate. Any technical questions along those lines in CPE, please do reach out to me, info@cpawebengage.com. Any questions about the content and getting started and moving forward, obviously you see Roger's contact information right up on your screen, and I encourage you to reach out to him directly. So you do have the link for the upcoming webinars. That is in the chat bar. We'll keep a copy of the slides available to you in your account for you to use as a resource going forward. So with that, Roger, thank you so much. Also, thanks to Dan, who's been answering a lot of questions in the background through the chat panel. Thank you both. Looking forward to your next session coming up soon.
Thanks, Matt. We'll see you on Wednesday.
See you then. Thanks.